Hello everyone, welcome back to another investors video on my channel. Today we're going to be talking about why you should not be panicking even with the current sell-off. If you're new to this channel, please subscribe, make sure you hit the subscribe button. Also, please if you'd like the video, make the like button go blue, that's fantastic, that'd be great. I'm trying to hit 200 subs, I'm around 130 at the moment. The growth since 100 has been pretty great actually. In about a week I've got another 30 subscribers, so thank you everybody who subscribed in that time. I really do appreciate it. Helping my goal towards the ultimate 1000. So today I'm going to talk about why nobody should panic about this investor sell-off. One thing to keep in mind is that this is all my own opinion. This is not a recommendation to you specifically, but this is my own opinion. This is what I think is going to happen, and in no way can I predict the future. I'm going to give my 2 cents anyway. So here we have the Nasdaq 100 index. This has been the index that's been hit the hardest by the recent trade talks. It's in percentage-wise, not in points. Obviously, the Dow Jones is the larger points number, but the Nasdaq has been hit by 3.43% as of right now. And this represents here, if I just draw a line here for you. So this is the current distance of the sell-off there, rather than this one here was from December. This is the December sell-off, and if you've been investing since then, you will remember this sell-off. The world was ending when this was going on, and then as soon as we turned to a new year, here as you can see into January, it's flown straight back up. What I'm saying is this is a minor drop currently. We've had drops like this before. Back in the 12th of March into April, we had a drop again, and what happened? It rallied straight back up. This isn't going to happen every time, but you can see here even back in 2015 we had a drop back up in 2016, drop back up. This is just the way the stock market works, is what I'm trying to say. So don't be selling straight away. I wouldn't be locking in those losses if you've recently been invested. If you've recently bought stocks at this point here, I wouldn't be locking in losses right now. I'd hold your money, hold your stocks. You've still got the same amount of stocks, and if you believe in the company, the share price should not matter a lot short term. If you're a long-term investor, you believe in the company long term, you're happy with the balance sheet, it's got a strong moat around it. So what that means is it's not rife for disruption by a competitor coming in or someone coming in to undercut. If it is a strong company, strong balance sheet, growing revenue, growing earnings, something you think is going to be useful in the future, something you think is not going anywhere anytime soon, then if you still believe in the company, the short-term share price should not matter to you. If we have another look at the Dow Jones, which has fallen again, here I've drawn what happened in the end of last year, which is 2018, to the start of 2019. And you see since then, since it dropped, this is quite a big drop. Everyone thought, literally, like I said earlier, the world was ending. But it's gone up 22.86%. It's gone on a huge rally since then. So if you think about, if you've bought up here, you sell down here, you've locked in your losses, that's not something you want to do. So people were selling off down here thinking this is going to be another 2008. This is going to be 50% off the share price. This is going to be a disaster. And then a lot of people missed out on these good days. JP Morgan did a study, and I can't quote the exact statistics, but it was something like the best 10 days in over a decade period, a 10-year period. If you missed the best 10 trading days, you missed out on a huge amount of money. So if you just missed those best 10 days in the market, if you haven't had a look at that study, I'll try and put a link in the description of the actual link to the study, but it was unbelievable how much money you lost just missing those very crucial best trading days. And if you get out somewhere on the bottom, you do have the possibility, if it is going to bounce back, which it could, if these trade relations end up sort of simmering out and they do manage to work something out, you could easily see this jump straight back up, as long as it's a profitable deal for both sides. So the Prudential, sorry if I pronounced that wrong, I've posted this. So this is about long-term earnings. So this is UK equities and global equities. So here you are. This is in a 1-year period, 74% of people made money in the UK equities. In a 5-year period, 80% of people made money. And in a 10-year period, 97.5% of people made money, with only 2.5% of people losing money. And that's even lower for global equities, with only 1.7 losing money in a 10-year period. And that's crazy, obviously. So what this is saying is, if you jump out, you do have a much higher chance of losing money. Whereas if you're in it for the long term, you stick the course, the likelihood is you're going to make money. The odds are most definitely in your favour for making money. And it also says here, time. So invested time in the market is much more important than timing the market. This is obviously, many investors have said this. I think Warren Buffett even said something similar himself. But I think it says here, as an investor who stayed in the market throughout the past 20 years, would have earned good returns well above inflation. If, however, that investor had attempted to time the markets, he or she may have missed the best days. And because the market can move sharply over the short term, these days are very important. So that's something I was saying earlier about that JP Morgan study, which I will link down below. And this is about pound cost averaging. So for investing, if you're going to invest every single month, you're obviously, like I was saying, you're happy with the company, think it's going places, so you decide to put in £100 every month. And Prudential have released this very helpful chart here, which if I zoom in a little bit for you, you can see this a bit better. So here it is. We have so you're investing £100 every month in month 1, 2 and 3, and the share price goes from £1 in the first month, £2 in the second month, to £3 in the last month. Great share price growth, by the way. Be very happy with that. So anyway, you end up buying 183 shares. Obviously, you bought 100 in the first month at £1 a share, putting £100 in, and month 3 you only bought 33.3 because it was £100 and £3 per share. But the average price of the shares you bought only ended up costing you £1.64, even though the share price is now worth £3. So what that says is, because you invest over the long term, you end up better off if you sort of drip feed it rather than trying to time the market. If you just keep going, keep regularly investing, ride it down and ride it back up, that's where you make the money. Warren Buffett has a great saying where he says that investing is a game where money is taken from the impatient and given to the patient, and I think that's so true. But even that was in obviously a rising market, the share price rising. They've also got a falling market one where the share price falls from £1 down to 33p. So you end up with 522 shares, and the share price finishes at 33p. So obviously you end up purchasing, the average share price is 54p per share. However, if you'd have invested all of your money in month 1, rather than drip feeding and trying to time the market in month 1, say month 1 you think is a great value, you're very happy with it, you put all your money in month 1, you've paid £1 per share for the price of all of the shares. It comes to month 3 and the share price is worth a third of what you bought it for, and you've bought them all at £1 a share. Whereas, I know it's not brilliant still, but if you've done the pound cost averaging, you are now only paying 54p per share, and this does indicate obviously you have a much better chance of earning your money back because you don't need to go up as high a percentage. Obviously, when you're at 33p a share, you need the market to then triple to get back to where you were, which is obviously that's no mean feat. So yeah, they say here they believe in that the longer an equity investment has been held, the less likely it is to lose money and the more likely to make money. So I really do agree with this, and I don't think that anybody should be panicking currently with the sell-off or anything like that, the short-term falls. And if you do believe in a company, you find a company you've liked, you've been watching the company for a little while, you could view this as an investing opportunity actually, rather than something to fear. So I've sort of been doing this recently. All these companies coming out with poor earnings for this time. You've got to be careful who you're investing in with poor earnings, because if there's genuinely poor earnings and that is for a reason and there's going to be a long-term decline, then that's something you want to stay away from. But if you think it's only going to be a one-off and it's in a cyclical market, that could be a good time to buy. You might get a much lower PE ratio than you would have before. And also something like this, which is not actually the stock's fault. So something like the US-China trade deal, where the company itself is the same. So you have Apple, which I believe were 5% down today, I think, so far when I last checked. Don't quote me on that, but today they were 5% down. And obviously, Apple will be affected by the China-US trade. However, whether the company's going to be worth that much less, and I believe it's probably around 10% down overall since the news was sort of happened last week and everybody had a red week last week. But is the company going to be worth 10% less as a whole because of this new tariff, which could only be temporary as well until they work something out? I don't know. I don't believe so. So yeah, what I'm saying is I wouldn't panic yet. Don't be selling off all of your stocks. Don't be locking in losses right now. You want to be investing regularly. You want to be investing into companies you believe in for the long term. I personally, I'm going to own up to you, I am not a very good timer of the market. I've never tried to do that. I know that is not my forte. I stay away from timing the market. I just try to find value companies that I think are going to have a good future, and companies that I understand. Most crucially, I don't do anything too complex that I'm not going to understand. So I like finances, so I buy financial services companies, banks, those sorts of things. I quite enjoy those. Anything like that. So technology stocks. I'm in the technology industry myself, and so I understand those sorts of stocks as well. But yeah, what I'm saying is you want to find a stock you understand and keep investing regularly. Regular investment is the most crucial part of this. It's drip feeding, pound cost averaging, like said up there. It's all crucial parts of this. So thank you very much for watching. If you haven't subscribed already, I know it's only a quick video today, but please subscribe. I have some analysis videos coming up later this week that I really think you guys are going to enjoy, especially with the drama going on in the stock market at the moment. So if you'd like to see those, please subscribe, put the notification button on, like the video. Also, comment down below if you have any stocks that you would like me to analyse, any sort of stocks that you're tickling your fancy at the moment, you've had a look at, you're watching, let me know. I'm happy to analyse them for you, release a video. I've done that in the past for a subscriber, so thank you very much for that recommendation. Thank you for watching, and I hope to see you in the next video. See you later, have a good day, and good luck investing. Bye bye.